Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil. Paris rapeseed. Between mid-June to October 2023, the market had been trapped between two congestion bands, one below between 438 to 445 and 3/4 and another above between 513 and 3/4 to 519 and a half. And during this incarceration, the market constructed a head and shoulders top with extension to its second shoulder from mid-August until the start of November. The problem the market suffered during the time of its testing down of this neckline, currently at 466 even, had been the sheer amount of force necessary to push down through this head and shoulders top neckline and try and fulfill targets below. Now what I mean by this is that we not only had the neckline to try and push down through, but nearby was also the previously mentioned congestion band between 438 to 445 and 3/4. And this contained the March, April and June 2013 highs at 442 and a quarter, 442 and 438 respectively. It looked as if prices had finally managed to break lower in early October, but the market turned back up and back into the congestion and then fell away again, rolled up and fell away, creating a small reverse head and shoulders pattern in October and November last year, for again sitting on top of the 438 to 445 and 3/4 congestion band. This for a while not only moved the market away from a break lower, but into a possible false break lower territory. However, whilst this all happened, there are some key bearish pressures that prices had to start dealing with, ones which I detailed 11 weeks ago and repeat now, and I quote, "We have overhead a more diaphanous congestion band between 456 and 3/4 and 468 and 3/4, a band that was relatively easier to navigate than the others mentioned, which now has three key potential bearish pressures within it. They are the declining short medium moving average, currently 436, then the medium moving average, currently 441, and then the declining long moving average, currently 447 and a half. At least two out of these three are descending to impact the market, and one should not take away anything from them, especially any efforts to pressure the market from above." End of quote. The short medium moving average was the key bearish pressure. It had been impacting the market since early November 2023, and the build-up of bearish pressure and the erosion of the bullish incentive eventually saw an initial break below the 438 to 445 and 3/4 congestion band in late December last year, and a proper break below at the start of January this year. Now the move lower was not without incident, as the old lows from October 2023 caused prices to revert back up mid-January, up to the overhead congestion area. However, once up there, the market made a horn top in late January, and we are now making new lows and low closes not seen since early June 2023. This now brings into focus some potential pattern targets I laid out some 13 weeks ago, plus some cautionary potential supports below. Thus, and I quote, "For the head and shoulders top pattern, hence a primary target X would be in the 400 even zone, with a secondary hard to reach target X1 in the 354 zone. Any move lower towards these would be very, very interesting, as we have alternate neckline 1, currently at 402 and a quarter, and alternate neckline 2, currently at 406 even, both in the way and both originating back from the old November 2019 to February 2020 head and shoulders top. They are highlighted in bright red and green respectively. Additionally, there is the December 2020 low at 396 and 3/4, which is also in the way on any move lower. I would further note that these three supports stopped the fall of this market back in May this year. By May this year, I of course mean May 2023. And that's the end of the quote. Winnipeg canola. Last year, the key patterns here had been the July to September double top, which we've seen play out to both primary and secondary targets. Then below that, the neckline, Specifically, the neckline of the earlier mid-April to early July reverse head and shoulders bottom, which is highlighted in purple on my daily chart. And that's currently at 676.70. After this, what I consider to be one of the more important patterns here is the broken bearish Andrews pitchfork created by the earlier double top from the mid-July to late August move. On this last pattern, the market broke up and out on the top side of this pattern, but failed to push up through the short medium moving average, currently at 658 even, which was a significant failure. Finally, there was the combination of the October to November last year reverse head and shoulders continuation pattern, which also had an ascending triangle, which admittedly was not the best looking version of this pattern, but it nevertheless still worked. It utilized the neckline of the reverse head and shoulders continuation pattern, currently at 730.60, as the flat topside trend line, and the late October uptrend as the lower rising trend line. The failure at the testing of the short medium moving average throughout November led to the drop down and out of the ascending triangle. Prices moved down through the neckline of the mid-April to early July reverse head and shoulders bottom, and along and sometimes below the broken upper tine of the broken bearish Andrews pitchfork, finally separating away from it in mid-January. 6 weeks ago I said the following, and I quote, "My concern with this move lower was that this could be seen as a precursor for a move down in the other oilseeds and veg oils. My thinking was that such a move could be seen as the market seemingly choosing to try and form a bearish halfway hesitation over November, with potential all the way down to even the 580 zone. This is not a done deal, and I have not placed any targets below, but it is worth considering in the coming days and weeks. In the meantime, let's take a look at the break below the descending triangle and see what and where this leads us. Thus, the primary target was in the 676 zone, with a secondary harder to reach target X in the 642 zone. In less than a week after the break low, the market had reached the primary target, and it was not too far away from the secondary target at 642. It is time now to see if the market makes this secondary target a reality." And that's the end of the quote. In early January, the market achieved target X. It now leaves us with potential below for the late August 2023 to date action down in the 580 zone, which I have designated as target X1. Finally, I would like to highlight the obvious in blue on my daily chart. I've drawn a bearish shift pitchfork for the late August to mid-November 2023 action to show the bearish angle of attack of this market. Prices are currently ever so slightly just above the middle time, currently at 595.40. As a postscript, I would add the following, which I said some 6 weeks ago, and is turning out to possibly be true, and I quote, "I would add this final thought. I am increasingly becoming interested in knowing if this contract is really an indicator, a leader if you will, of what the other oil seeds and veg oils may have to deal with." End of quote. Bursa Malaysia crude palm oil. I have said this so many times, but I will keep saying it until it is no longer true or valid. But the mid-August to early November 2022, that's right, August to November 2022, well over a year old, mildly bearish shift pitchfork, the one highlighted in dark blue on my daily chart, is still running the show here after so much time. This mildly bearish pitchfork guided prices more or less lower. Initially, in between the upper time, currently at 39.71, and the middle time, currently at 33.38. Then for a while in May and June last year, between the middle time and the lower time, currently at 27.06, before prices moved back up again in between the middle and upper times. The significant patterns within this bearish pitchfork have been the June to September 2023 diamond pattern, and the late July to late August 2023 move we'd seen there. In mid-November, prices broke up through the upper time, as well as the short medium moving average, currently at 37.94, and the 50% Fibonacci line of the June to July 2023 move at 37.06. The rise continued, breaking the cap seen here back in mid-October 2023, then up over the purple neckline, currently at 39.53, of the September to November 2023 reverse head and shoulders pattern, before failing to exploit the move up any further, and finally running out of steam at the February 2011 high and at 39.53, and a further congestion seen overhead at 39.86. In mid-November last year, the market made a lopsided horn top and dropped back down through all these resistances that have become supports and are now back as resistances. The drop was enough that the market reached down, breaching but not yet breaking the bright red trend line. The bright red uptrend trend line, currently at 37.01, dating from late May 2023. Now the market had two attempts at trying to break the uptrend, and also the interesting 61.8% Fibonacci line at 35.92 of the late May to late July 2023 move, but failed both attempts, and instead caused a small early December 2023 to mid-January this year double bottom to be formed, reaching up to its topside target soon after in late January. This move up also tackled on the top side the purple neckline and the dark blue upper time, managing to make two consecutive closes over the upper time, but ultimately failing to exploit the move, eroded once again by the overhead resistances, and prices have once again dropped towards the bright red uptrend. So what now? Well, this market, unlike the other oilseeds and veg oils I've looked at today, is not wholly concerned with going lower. The bright red, whilst breached, is still repaired. The bright red uptrend is still breached, but is repaired also, and intact for the moment. We do not have, or we should have, we do actually have a double bottom pattern, a bullish one, but one can argue that is within a possible larger big M pattern, stretching from early October 2023. In addition to this, the reverse head and shoulders pattern over autumn last year, especially the purple neckline, is acting as a sort of a cap on this market, much as a head and shoulders continuation pattern would be, except it is going higher each time. Overall, I would suggest watching what the market does at either the blue upper time or the red uptrend, and the lesser Fibonacci line at 35.92 to gauge any clues as to what may be next. I suspect with the uptrend and the upper time converging, it may not take that long. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.